You've probably noticed it by now. The stock market just keeps going up.
Even as we move through late October 2025, the S&P 500 and Nasdaq are near record highs. And yet, the economy isn't exactly booming. Inflation is still hanging around. The federal government is partially shut down. And global tensions, especially between the US and China, are heating up again. So how is the market still climbing? Why does it keep defying gravity? Let's break it down. Earlier this week, both the S&P 500 and Dow Jones rose about 1%. The Nasdaq gained even more, driven largely by one name, Apple. Apple's stock surged after reports showed massive demand for the new iPhone 17, especially in China and the US. That single move lifted the entire market. And that tells you something. This rally is being powered by a handful of mega-cap tech giants. But it's not just Apple. Many large corporations are reporting stronger than expected earnings this quarter. Analysts keep raising their profit forecasts, and that optimism keeps feeding investor confidence. Tech continues to dominate the narrative, and because those stocks make up such a big share of the indexes, even small rallies in those names push everything higher. Then there's the interest rate story. Investors are betting that the Federal Reserve won't hike again this year. Some even think rate cuts could come in early 2026. When rates fall, or even when the market expects them to, future earnings become more valuable in today's dollars. That's what analysts mean when they talk about discount rates. So lower rates make stocks look cheaper on paper, even if the companies themselves haven't changed. That alone can fuel huge rallies. And don't underestimate psychology. When investors see the market rising despite bad news, it builds confidence. That confidence leads to more buying, and more buying pushes prices even higher. It's a self-reinforcing loop. This is what's often called the wealth effect. As portfolios grow, people feel richer, they spend more, and they keep investing. It becomes a cycle of optimism feeding on itself. There's also a structural factor most people overlook. The stock market today is dominated by passive money, index funds, ETFs, and algorithmic trading systems. Every time someone contributes to a 401k or an index fund, that money automatically flows into the same group of large companies. Apple, Microsoft, Nvidia, Amazon, Google, Meta. Those inflows happen regardless of headlines or short-term data. It's mechanical, and it helps keep prices elevated even when parts of the economy look wobbly. Globally, the story adds even more momentum. Japan's Nikkei index just had one of its strongest weeks of the year after pro-stimulus parties agreed on a new economic plan. That rally spilled over into US markets. Meanwhile, investors breathed a sigh of relief after hints that the US and China might resume trade talks later this year. Even a small step toward de-escalation can lift global sentiment. So between tech optimism, foreign tailwinds, and passive flows, you get a market that feels unstoppable. But here's the twist. The US government has been partially shut down since October 1st. Nearly 1 million federal workers are furloughed, and hundreds of thousands more are working without pay. Historically, that kind of dysfunction would shake investor confidence. But not this time. Why? Because the shutdown was expected. And because it delays government data releases, there's actually less bad news flowing into markets. Investors are taking the silence as a neutral signal, almost as if no news equals good news. It's an odd paradox, but it's working in the market's favor, at least for now. Still, beneath the surface, the rally isn't as strong as it looks. Only a small group of companies are doing most of the heavy lifting. That's what analysts mean when they talk about narrow market breadth. If just one or two of those big names stumble, say Apple or Nvidia, the whole market could wobble. The International Monetary Fund recently warned that US stocks could face a sharp correction if megacaps start missing earnings expectations. Valuations are also stretched. Price-to-earnings ratios are back to levels not seen since 2021. Investors are paying a big premium for future growth, and that only works if the growth actually arrives. A lot of this optimism hinges on the AI story. Companies keep promising that artificial intelligence will boost productivity, cut costs, and reshape entire industries. That narrative has become a powerful force. It's giving investors a reason to look past slower GDP growth or sticky inflation. But not every part of the market is celebrating. Regional bank stocks have been struggling again this month. There are quiet concerns about credit exposure, especially in commercial real estate. Small cap stocks are also lagging badly. The Russell 2000 index, which tracks smaller companies, has barely moved compared to the S&P. That suggests the broader economy isn't as strong as the headline numbers imply. Energy prices have also been volatile. Oil briefly broke above $90 a barrel earlier this month before cooling back down. If prices spike again, it could reignite inflation worries and complicate the Fed's next moves. So why does the market keep rising in spite of all this? Because markets are forward-looking. Investors aren't trading on what's happening today. They're betting on what will happen 6 months from now. And the consensus outlook right now is that inflation will continue easing, the economy will avoid a deep recession, and rates will eventually come down. Put simply, investors believe the future looks smoother than the past 2 years. And belief is a powerful thing. There's also an emotional side to this rally. After years of volatility, people want to believe that we're entering a new era of stability. The soft landing narrative, where inflation cools without a crash, has become the story everyone wants to be true. Add in the excitement around AI, and the market feels like it's caught in a wave of cautious euphoria. But not everyone's convinced. Some analysts say this feels like the late stages of a bull cycle, when optimism is high and skepticism is low. They point out that options trading volumes in big tech have hit multi-month highs, and corporate insiders are selling shares faster than at any point since 2022. That doesn't mean a crash is coming tomorrow, but it's a reminder that even insiders are locking in profits while prices are high. So what should investors take from all this? If you're investing for the long term, stay disciplined. Diversify your holdings. Keep some balance between tech and other sectors like energy, healthcare, and industrials. The U.S. economy has proven remarkably resilient, and real productivity gains are emerging from automation and AI. But this isn't a time for complacency. A market this concentrated, this reliant on future optimism, can turn quickly if one assumption breaks. If you're trading more actively, it might be time to take some profits or trim exposure to the biggest winners. The next few months could bring more volatility, especially as earnings season continues and the Fed's next policy decisions draw closer. Remember, markets don't move in straight lines. Even strong rallies need to cool off eventually. The key takeaway for October 2025 is simple. The stock market keeps going up because of earnings optimism, AI enthusiasm, expectations of lower interest rates, and relentless inflows into passive funds. But that strength hides fragility, overvaluation, concentration risk, and investor complacency. Right now, belief is driving the market more than fundamentals. And belief, as powerful as it is, can change in an instant. So as we close out this month, the market stands tall, defying bad news and rewriting the rules once again. But if history teaches us anything, it's that when everyone believes the market can only go up, that's often when it reminds us that gravity still exists. For now, optimism is winning. But stay alert, because markets have a funny way of testing that belief when you least expect it.